call the meeting of the Human Resources, Finance, and Property Committee to order. First item is Pledge of Allegiance. Please rise. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. We have a quorum present with Supervisors Hart, Leahy, Lemmer, Gibbs, and myself present. Supervisor Zhang is excused, and I think Supervisor Marshall we're waiting for. Public comments. Nobody has approached either of us, so we will move on to the approval of the minutes from the January 10th meeting, which were in your packet. What are your wishes? Moved by Supervisor Hart, seconded by Supervisor Lemmer. Any discussion, comments? If not, all those in favor of approval of the minutes will signify by saying aye.
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 Opposed, no. That motion carries unanimously. Claims, we'll now move on to operational functions. Claims disallowance on Peggy Meyer. Mike?
Thank you, Mr. Chair. My comments on this claim are actually going to be relevant to the next one as well. Both of these claims arose from some damage to vehicles that occurred on county highways. They were tendered to our insurance company. Our insurance company has asked that the committee issue a formal disallowance for the claims because the county does not have liability. There's no indication of any notice or negligence on the part of the county in maintaining the road. So that is the recommendation of WMIC as to both claims. So specifically as to this claim for Ms. Meyer, the recommendation from our insurer is to disallow the claim.
Are there any questions of Corporation Counsel? What are your wishes? We can either deal with them individually or collectively. Chair Gibbs.
I'll make a motion to disallow both the claim by Peggy Meyer and Zach Decker in accordance with recommendations from our insured carrier.
Is there a second? Seconded by Supervisor Lemmer. Any discussion? If not, all those in favor will signify by saying aye.
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 Opposed, no. That motion carries. For the record, Supervisor Marshall has joined us. Update on NREM tax deed process and next steps. Corporation Counsel, Mike Pruner. Or Connie, Fire District, the treasurer.
Okay, so when we started the NREM process, we had 38 parcels that we sent letters to. As of today, we are only taking 21 of them, as the 17 of them already paid in full. And that comes to an amount of $108,662. With this collections and throughout the year of 2022 and 2023, we have collected $6,151,505 in total delinquent taxes, which includes, with our next phase, we had 177 properties. We have already dropped off 39 of them, which we are removing because they are paid in full, which is part of that $6 million. So the NREM process is working. People are realizing that the county is being very active in getting the parcels paid. So it is working like I said before, it was kind of the word of mouth. I just want the committee to realize that all municipalities, when they come forward looking for parcels, they are paid in full. So any of the tax delinquent parcels that are not collected within the municipalities, they've already been settled. It's only the county that is out the money. So I just want the committee to understand that. So if parcels are paid up and are within the 2 years, the county has to stop the notification of taking the parcels because we cannot continue. They have to be 3 years delinquent as of September 1st of that year. So if we have some of them that have paid up to the 2 years, we have to stop the notification. We can't take them anymore. We'll have to start over. The next step that we are going to be taking is obviously to continue the research. I just want to let the committee know that any fees that are incurred in the treasurer's office are already applied to the parcels of interest that we are taking. We are looking to take 10 to 15 parcels per month. Obviously, that's starting with the letter, which is a 90-day payoff, and it's a notification to the lien holders, any mortgages, and any person of interest that is found through the research process. We plan to publish as soon as we get these letters mailed. We plan to publish because we have to publish them 3 consecutive weeks, but it doesn't start the process until the 3rd week. That's when it starts the full year. So we want to get the publication as soon as possible. The publication is quite expensive. We do want to add as many parcels as we possibly can on that publication. And then once the publication is completed, we divide the cost of it amongst the parcels, and that gets added to the parcel immediately. So any fees we're incurring is immediately added to the fee structure within a cent. After the 90 days, a foreclosure letter is given by Corp Counsel, and then that starts another 30-day process. After the 30-day mark, a court hearing with a decision to take the parcels is held. So we want to continue with this process till all properties are resolved from tax delinquency. And again, our goal is to get the people to pay their property taxes. And if they do, the county has no interest in the property anymore. So like I said, this doesn't include the municipalities this does not exclude municipalities from approaching the owner of the properties to do a private sale. It does not need to go through the county, but if someone is interested in the property, like I said, I've encouraged to do a private sale. We've had a lot of residents come to the county treasurer's office requesting ways that they could pay their properties. If their properties are too far gone with paying us back, we have encouraged them to go get a loan from a bank and pay off the county, and then just use that towards having the bank loan. A lot of them have complied to that, and they have come to pay, and some of them, like I said, a lot of these parcels have a story. So we encourage them, we kind of tell them this is the way that it is. You have to pay your taxes or the county can take them, and they do realize that. And all taxes must be paid before there is a sale of a property. So if there is a private sale, it's got to include those taxes because they do contact us and we tell them the full payoff. So, and we've also had several banks contact us. We are also trying to encourage the banks to work with my department because if you have a mortgage on a parcel, you're actually defaulting on your mortgage contract with them because you're not paying your taxes. And a lot of banks don't realize that, well, why aren't they paying their taxes? You have to talk to your customer. So that is my report right now. Anybody have any questions?
Well, thank you for that update. So the universe is you said 177 tax delinquent?
Well, that was the second phase. We've already had all of those parcels researched. We have 39 of those already paid in full. So they are dropping off.
So what is the universe of tax delinquent, not, irrespective of phases?
Where we are. So the phase 1 was the first 50. Okay, so that's the 21 we're taking because 38 of those parcels already, we started with the 38 of them. Okay, so 21 is what we're taking to court because those 17 already paid in full. So because we were in tax season and we're in settlements right now, we will be working again on updating the list, but it's a working document for us, and we continually look at it So once those parcels pay, we check them off, and it just keeps dropping. But if residents don't pay and they're already in the 3 years, so they don't pay 21, 22, and they don't pay 2023 come September, then it rolls up again. So we're always in that fight with those parcels when it gets to that 3-year mark. So we're trying to encourage people to pay their taxes and not get that bad. But it is hard to identify them. A lot of people don't necessarily want us telling them what to do with their parcels, how to pay their taxes. We give encouragement only when we're asked. We do only have, at this time, 9 parcels that have agreements. We had 45, but they all defaulted on those agreements. They either didn't pay, gave us NSF checks. They told us they changed bank accounts. I mean, there's situations with those. Too many NSF checks, and we want cash, and then they weren't able to pay them, so they defaulted, so they're off the agreements. So going through all of them, we started with 45. We now have 9 that consistently pay, and they are being monitored monthly.
So, go ahead, Chair Gibbs.
Yeah, I think what Chairman was asking, though, was, at one point we had plus 400 and some properties that were more than 3 years delinquent. And I understand we had phase 1 with 38 properties, and of those, several have paid, 17 have paid, 21 are now going to court to be taken by the county. Phase 2 was 177. That still left from the initial 400 plus 100 and some properties. Where are we at as far as the total number of tax delinquent properties that are 3 years or more is, I think, the question that we're asking.
Okay, so the total number I don't have. Those first 50 were like 10 plus. So now these other ones, the part of the 177, I would say half of them are at least 3-4 years. Some are still 6 and 8. There's a variety of them, but it's the years that we can take it. And we basically how we went after it is the ones that were in the worst condition. But also part of that initial 400 was the properties the county didn't want to take. They were contaminated. And then there's also the slivers on there, which, again, we're working with CPZ and the property lister to identify those. The problem is we have to identify them to get them off the list. We have come across a couple of them, but the residents around that sliver of property don't want it. So we either have to look at taking off the PIN number on those slivers or trying to incorporate with another property. It's questionable, but what are we going to do with those? And I think we kind of identified, don't quote me, like 20 or 25 slivers that are part of that. So there may be more. So, but as they're going through the GIS mapping, they're finding them. So there's a lot consumed in that initial 400 list. We do have, like I said, we have people paying their taxes, but then again, for me to try to identify those right now, it was hard because we're right in the middle of tax season, so.
So when the people are reconciling their back taxes, are they reconciling 1 year or multiple years?
Multiple years, because they realize that, I guess I didn't realize I was that bad, and when we initially gave them the letter, they didn't realize how bad it was, or it's a family member, it's a parent that wasn't keeping track of them, or it's just they didn't care. I mean, it's a scenario of issues, and some of them, I did have one this week that he indicated that his mom passed away, is going into probate. So there's also the bankruptcy and probate on some of these. But if I don't have the documentation, it has to be filed. Otherwise, you're telling me that it's bankruptcy. I need proof that it is. Because last year I did have a resident come to me telling me that he wasn't going to pay like 6 years worth of taxes. And I said, there's nothing that was indicated in our research that you even had a bankruptcy. And I had a lawyer contact me, and Mike have been working with this person. So there's no bankruptcy filed. So you filed it, but it didn't go through. So we do get scenarios like this. So we take each parcel as it comes in. So we look at every legal aspect of it. And there's some people that have come forward to us that have a lien on it, but I don't have anything in writing from them. And I said, you can wait for when this property, when we set a court date, you can meet us, you can come to court. So we don't know what this is going to look like. And I said, like, again, we are anticipating 10 to 15 parcels a month, maybe more. We have to see where the judge is too, like if 30 or 40 properties are okay to take.
So if we're doing 10 to 13 properties a month, is that the 21 cases? Or,
No, the 21 cases we're taking right now. We'll
Okay.
be taking in a month.
so you'll be doing an additional?
Oh, yeah. This
we've
is
got-
all into addition.
So we have properties where the city of Wausau has expressed an interest in a property on 6th Street and on Thomas Street.
Mm-hmm.
Are those in the next list?
Well, the one that was on 6th Street, it was raised, so that property is no longer there. It's just a piece of land now.
But there's still a tax delinquency.
Yes, there is still a tax delinquent. They are on the list. So they're
would we-
further down the list. I mean, they're on the list. They're like number, I think that one was like 127 on the
So
list.
where are we relative to the 10 years on that property?
I think that property is only like 5, 6.
So based on our, the reason I raise that again is we forgive the taxes after the
Correct.
10th year.
Yes.
And so I would, if we've got an interest in those properties, we should try to move them.
Those are the ones we're working on right now. Those are the ones that are of interest right now that are the worst. They are the highest years of delinquency. That's the line, that's the list we're working on. We're going down each one.
Chair Gibbs.
So the 177, are those, where are they in the delinquent tax? Are they in the year 5, year 6? Do we know, what's the, how close are we getting towards the potential taking of properties when they're less than 4 years
Okay.
delinquent?
So the list goes from the worst, which is the
Right.
most years, to the least years.
Right.
So we're going down the line.
Right.
So right now, I don't have the list in front of me to see that as far as years go.
Are there other questions? Connie, thank you very much for that update. Oh, Gail, go ahead. Supervisor Marshall.
Thank you, Chair. Great job. And $6 million is what you've collected so far. That's awesome. I don't recall us having a budget for what we were anticipating collecting. So does that mean that that's a windfall to this year's budget?
No.
You want to take it, Christy, but the short answer, no, I don't think it's a windfall.
So those certificates are run to the balance sheet, and so they're being applied against the certificate years.
Go ahead.
But it was revenue you weren't anticipating from what I understand. Because without this action, we would not have collected it. Is that true?
But it was booked.
But it was booked because in the year of the property tax levy, we levy the tax, and in almost all cases, we receive over 99% of all taxes. So you could
So
theoretically write it off, but it's immaterial. And so what happens is that we then have a balance sheet called 2008 payable 2009 tax certificates, and then we apply them against those tax certificates because it becomes a tax receivable owed to the county.
So if it's over 10 years old, do you write it off then?
Yes.
And my other question was...
We do that, Gail, Supervisor, by state statute.
Okay. And my other question was, we had a discussion about collecting a fee related to staff time. So I know you're collecting our out-of-pocket fees. Are we collecting any staff time? Thank you.
Yes, there's $150 that we encompass my staff time and includes mailing. So all that's already, once we submit the letter, that's already in there because that's our biggest part of the process is the research is in there and then my staff time is in there. And then any other fees that we are aware of that have already been done will be added to that as we continue to keep going. So it just keeps increasing it.
It
And
sounds
save
like,
save that question for Michael's presentations. And
I was going to say, because we have court counsel staff time in there too, which lends me to believe that our costs are much higher than $150. It seems like that's not enough to cover real staff time.
so under the process, Connie's role in the process is the taking of the tax deed through the MREN. Once that happens, it shifts from Connie to Kim with Mike's involvement. So in the establishment of the price we will sell it for, that's a different set of parties. So we will.
Right, but if Mike is involved with the staff, with the treasurer to actually collect the taxes, $150 does not seem an appropriate amount, given the amount of time I'm sure that you're taking, and I'm sure it varies. So just want to be cognizant of if these are becoming more time-consuming, that let us know if the 150 is not appropriate. Thank you.
I just want to let you know too that once the property, if the county takes the property at the end of sale, we're under Act 216, which we just did a payout of a property. So all of the expenses that are incurred with the county plus the taxes of the time we took the property, all get considered before we have to pay out any proceeds because we can't retain those proceeds. We can only retain what expenses were incurred by the county.
So your, Supervisor Marshall, your question is when we're reconciling the back taxes that are due, we are charging interest plus the $150 fee. And is that interest at 18%?
18% per month.
So we're getting 18% interest on that outstanding balance plus the $150 fee in the reconciliation process. Does that help?
Can I add one thing, Mr. Chair? I think to Supervisor Marshall's question, I just want to add a little bit more context. My colleagues and I, we have been talking about this idea of how do you get at that,
Exact cost.
what is an appropriate fee and what approach do you take? Because as Connie referenced, that new act, you want to make sure you're charging all those fees because historically the county would receive we wouldn't have to make that payout for the balance of the property, the value of that property to the individual. So I know in conversations with my colleagues, we're kind of throwing around some ideas of, having a set fee that is assessed on every property as opposed to the idea that we track time because to your point, properties are different. So there's some advantage to having some tracking of time, but it's quite onerous. So certainly an opportunity to improve moving forward. I think once we go through this first batch of in-rem, we can go back, and my request of both Connie and Mike is going to be that you go back and kind of do that time study to see how many properties went through, how much time did we spend, and then we can talk about what an appropriate fee is. And then through the budget process, as we did last year, have the standing committees, and this standing committee would oversee this particular fee area, but implement that standard fee. I'm leaning toward the standard fee approach, but that's kind of my thought process to this point and some of the thought process of my colleagues that I referenced.
Kurt?
Yeah, I think one of the things that the concerns that I've been hearing from WCA's legal counsel and stuff is the fees have to be commiserate with the actual expense entailed. And so it has to be defensible that we be able to make sure that it's appropriate. So I think the approach of using, the first case study as a study on the effectively, 21 properties that will be taken on phase one, will give us some kind of idea as to, now, some of those might be outside the norm, but we'll get some kind of idea what the normal time allocation is by Corp Counsel's office and the clerk's office.
All right, any other questions? All right, if not, we'll move on to the discussion of tax deed property processes, selling value and assigning fees. Corporation Counsel Pruner.
Thank you, Mr. Chair. So if you'll recall, when we updated the tax delinquent property ordinances, we did address, generally speaking, setting value to tax deed properties when they're in the process of being sold once they've been acquired by the county. The idea was, if we're using that surplus property auction site, that we would set a starting bid at a certain amount. In the ordinance, it's at 50% of the assessed value of the property, just to give a starting bid. And that would hopefully spur an auction-like process where the best market value for that property is ultimately collected. I think this committee certainly has a role in setting alternative values depending on the specific nature of properties, if there are specific properties that we have in mind. And this discussion is only related to those tax deed or tax delinquent properties that the county has acquired. So certainly any other time we're disposing of county-owned property, the ultimate sale would need to be approved by the county board. Are there specific questions that I can answer about this process or the assignment of value or fees that we haven't already addressed?
Do we know how the 50% of assessed value compares to what we have into the property?
I think it depends on the property. Depends how long it's been delinquent and the value of the property. I don't know that we can have a good comparison. I think it's just going to vary. I think, again, once we have gone through this process a few times, I think we'll have a better set of data as far as what that looks like and whether this is a good value, because that 50% was, that's just a number. It's not based in any data set because we don't have any data yet.
So we are tracking that both in terms of what the 50, I would ask that we track what that 50% is, what the sale price actually is, and where that is relative to what the county has in the property. So we have an understanding of where we may have liability if we sell in excess and to return that to the former property owner.
Absolutely. That's part of the tracking process that we're doing and that we're going to have to do after that Hennepin County case, is to ensure that we are not retaining any amounts in excess of the taxes owed and the costs that we've incurred in obtaining and selling the property. So we'll have to track that very closely, and we can have that, I think, put into a format that we can review.
Chair Gibbs.
Just a question, in now rethinking setting that value at 50% of assessed value, does that set us up for a potential problem or challenge by the former property owner if it's sold for that 50% of less, or 50% of assessed value, meaning especially if there was excess equity in the property, are we setting ourselves up for a potential liability?
So it's a good question, and I think really your question revolves around if the property is sold at that 50% mark, is the county affecting a taking of this person's property by selling it for less than it's worth? We batted this around, and my thought is, since we're engaging a public sale, including an auction website, public notice of the sale, we have a defensible figure for the ultimate sale price. We've gone to market. The market has borne out what the ultimate value of this property is, so we can defend that in court when it's asked, well, why did you sell it for this amount? Because we took it to a public auction. There was notice of what the property was. We set a starting bid. However, we accepted the highest bid. And so I think that would be defensible.
So there's no opportunity for us to average those out over multiple sales. It is sales specific. So should we, following up on Chair Gibbs' comment, should we be looking at 50% of assessed valuation or basically, for lack of a better term, the skin in the game that the county has relative to its fees, back taxes, and assessments?
I mean, I think part of that would be a policy decision for the body, but I know there are some cases where the amount of taxes owed is much less than the value of the property, and there are some cases when it's much more. So I don't know that linking it to the amount that we have in it is also, I think that's also problematic for similar reasons.
But if we don't realize the gain above what we have into the property, is there a value in us setting that property value higher when we are going through a bidding process? Because we actually create additional burden on our staff relative to the reconciliation of the difference between the sale price and the county's cost. I'm just looking at it from a process perspective. And
I think I understand your question, Mr. Chair, and my initial sense, which I reserve the right to modify based on our experience with this first wave, is that adopting that approach that you indicated in the event that there's the situation where the amount owed to the county is greater than 50% of the appraised value, if we have confidence in the, assessed value, if we have confidence in the public auction site, that method of sale, we have confidence in that it will achieve a fair market, an accurate fair market value. The only potential outcome that I would see if you set the value at the amount owed to the county is that it would deter a sale and we would not sell a piece of property because the fair market value is less than what we're owed, which I think is reasonably likely to occur in some situations. Sure. So the question for the board is, do you want to be left holding a piece of property that has a fair market value less than what you owe, or do you want to get out from underneath it? But again, I reserve the right to modify that characterization if our experience is different, but that's my sense.
that scenario results in us writing off that difference.
Correct, but you'd be writing off less than what you'd be writing off if you didn't sell it.
So part of this discussion, Supervisor Marshall had raised it. So we have the $150 fee that we impose by the treasurer relative to the owner reconciling the back taxes. And there are other communities that have set values, and one in particular had a $500 corporation counsel or county attorney fee and a $250 clerk fee. And I just throw those out there for for illustration. And, the question is there a reasonableness to it? And, I think the question would be, do we want to try to set fees, and in the context of our review of the budget and the fees in the budget, look and see if there's a correlation between those fees and our actual costs going forward, and we could adjust those on an annual basis. But do you want to look at having, we do have, Mike's involved in this process, and he doesn't come cheap because he goes on cruises. Kim's a bargain, half the price, But, do we have a basis for that, and do we have a desire to try to set those? Gail?
Just putting a pencil to 2,080 hours per year. Legal services, Mike and the treasurer, 1 hour of their time is about $100 an hour between the two of them. Fully loaded would be my guess. So $150 just doesn't, I'm guessing you're not spending just an hour and a half on the properties. That's where I was coming from.
Chair Gibbs?
I think one of the things that we're struggling here with is, what's reasonable and what's reasonable expectation. I think, in prior to the court case where the excess equity has to be returned back to the property owner, the issue was a non-issue because any excess was retained by the county. And now, obviously, that's not the case, but I think there's an expectation that we have a reasonableness. And I think if we look in light of the 21 properties that we're going to be taking or concluding and taking at some point in the very, very near future, we can then do a reconciliation of what that is and then revisit the time and effort that's been put in and have something that's defensible rather than just using a number that we don't have anything that's defensible right now. We know that it's more than, and I get Supervisor Marshall's point that we know that it's clearly more than the 150 that we're currently charging Corp Council's time, 1 hour. Is clearly going to, be more than that. So I agree with that we need to look at that, but I also am cognizant that we need to be mindful of the defensible position that we have. Don't put ourselves in litigation.
Mr. Chair, can I make a suggestion just from an operational standpoint?
Please.
Once we get through this first kind of wave of these in rem, perhaps staff can calculate how much time we believe we spent on average, the most impacted staff through this process, and we can bring back a fee proposal to you. We can implement that prior to completing the second wave, and then we can further review it through the budget process. But my understanding in speaking with Connie and Mike is that Connie's working on getting the final pieces of information for Mike to schedule that court hearing. Our hope is by the end of the week, she has that information to Mike. He then has to schedule the court hearing at least 30 days from the date that those letters go out. So we should be able, in the relative near future, certainly well in advance of the budget time, to come back with a fee proposal.
Connie?
I just wanted to add that I feel that when I became the county treasurer, all the research was living in the treasurer's office, which was a lot of work and a lot of time. Having that research done by someone that's a professional at knowing what to look for helped us. Charging that $75. We've had, so like I said before, these are the worst properties that we have. So for one instance, there's 30 liens on one parcel. So getting all of the paperwork, all the letters written, that was time consuming. We are looking at all of that, but we also looking at each parcel is different. Each parcel has a history with it. Some have nothing. Some are like 5 minutes. Some are like over an hour. But that $150 that we're charging kind of works itself out between the ones that are not so busy and ones that are busy. We are watching that very closely, how much time we're spending, but just want to let you know, having that research done by a title company helped our office extremely in not having to spend this much time, and not because we don't know what we're looking for in specific properties, and they know what they're looking for. So it's quicker for them to do it. Once we had that option, we knew that it was going to work because we don't know what we're looking for. So, but we do consistently make sure and just do some double checks that there's nothing that popped up in between while we're working on this process. Did this owner go and do something again? Is there another lien sitting out there that, what did they do in between these 90 days and then additional 30? So we're always checking everything before we finally go after the property. So we are checking how much time we are spending in our office, so.
So we have, for lack of a better term, I'm going to say 3 sets of charges, and correct me if I'm wrong. We have the process charge of reconciliation of back taxes, and that is the preparation cost that Connie is charging for people so that we don't take it through NREM or tax delinquency. We then have those costs associated with us taking the property, which gets at Mike's role. So we've got the acquisition cost. So you're building, it's an iterative process. So all of a sudden, we've injected the corporation counsel's cost into that process because he's doing the filings with the court. We've taken the title to the property, and we're now at that point of sale or auction or whatever it is, and we bring in additional costs associated with Mike and with Kim in terms of our disposition. So do we want to give some thought about, at each of those steps, what are our appropriate fees so that we're recovering those costs? Is that the desire? So it's the process for the people to reconcile back taxes. It's the process cost associated with taking it through NREM, and is the process cost associated with actually selling it through surplus property or other means. Does that make sense for us to try to break down those costs? Chair Gibbs.
It does. The only thing that I was, I guess, the other question that posed in the process, since we're contracting out to a title company, are those part of the 150 that's being charged from your office, or are those directly added to the property as a separate fee that the title company is charging the county?
That is a separate fee. So it
That's
is
added.
separate, yes. What's incorporated in that $150 is my,
Your time.
yeah, my fee for my time, which I'm trying to eliminate like as less as possible. And it's the mailing fee because I have to send everything certified. So that's all incorporated in there. Instead of trying to nitpick each, this is $7, this is $3, it's just in the 150 fee. But we do have a template. All we're doing is using the same template, filling in the numbers, and adding the addresses and sending them as quick as possible. But it's like compiling the numbers, so.
Chair Gibbs and then Supervisor Marshall.
Well, I think we'll be well served by doing the study on the 21 and then being able to apply those to the next phase, which now looks to roughly 138 properties, taking into consideration that there was 177 initially in phase 2, but 39 of those properties have paid. So we could then be applying the Corp Council's costs, clerk's costs, whatever we come up with as far as an average cost that's a defensible number added to those 138 if those end up actually going to collection.
Supervisor Marshall.
Thank you, Chair. I also second that I would take the advice from the administrator after this first batch, and we'll see what the costs are and set the fee at an appropriate level. Thank you.
So I sense consensus on that approach, so I don't know that we need a motion. We would ask the appropriate parties to track those costs and bring back a report and recommendation at the end of that evaluation period. Is that acceptable? When do we think that might be in terms of a timeline?
I would say March or April, probably March. Second meeting in March.
Second meeting in March it is. Any other questions on this? All right, then the final issue is the policy surrounding disposition of surplus property. And we sort of got at that discussion earlier relative to, is it the 50% of assessed? Anything else you want to add? Mike?
The only other thing is just to reiterate the distinction between our properties acquired through the tax delinquency process and other properties that we own but have determined that they're surplus. Obviously, those would be handled differently because we have different processes that we are able to apply, but certainly we could and maybe should develop a policy relative to that as well, how those properties are reviewed, disposed of, and where the funds go.
I think, Kim, you were looking for some direction on that too, were you not?
Basically, I guess I wanted clarification as to, we're automatically setting the tax delinquent purchase prices at 50%, the starting bid at 50% of the assessed value with the minimum purchase price at the assessed value.
No.
I believe that's what the ordinance.
So the ordinance, as it's currently written, says this is again for the properties that we've acquired that were tax delinquent that now the county owns. So it's the county's property. We're disposing of it through our ordinance, through that surplus property online auction site. Our ordinance indicates that we list the property with the minimum bid being 50% of the assessed value. So I think that's what you said.
And then was it the minimum purchase price we can accept, or is it just whatever the highest bid turns out to be at the end of the?
We would need
Bidding
to accept the highest bid, but yet, right, the minimum price we would accept, I believe it's written in here, is that
50% of
assessed, 50% of the assessed value.
Okay, and then, I just had something else in my head. It's gone. I had another question, but it's gone.
If it comes back, let us know. So is, on an interim basis, while we're evaluating our process and evaluating where sales might be, is that I guess it's what the ordinance says, is so therefore, unless we have a change in the ordinance, that's what we'll do. Go ahead, Kim.
Are we okay to start listing properties, or are we still waiting for some clarification on the Hennepin County case as far as what we could do, or where are we with that?
If you're looking to me, I think we're okay. I think we've figured out what Hennepin County, what that case means, that we can't retain any excess above and beyond what we're owed and the costs we've incurred. So I think that frees us up to move to that next step. So I think we can.
Do we have the ability to charge carrying cost as part of that discussion? So we take a parcel and hypothetically, we have $50,000 into that through our payment to the other municipalities and our back taxes and interest in fees, but we've held it now for 4 years. Do we have the ability to say that in that 4 years, we've not generated any taxes and we continue to lose the value of that money through inflation? Do we have the ability to have a carrying cost to reflect those or that time period?
I'm initially thinking no, for a few reasons, but one of them being, if we chose to hold on to the property for 5 years, I don't think we can attribute that to anything except our decision or indecision to do that. I don't think necessarily we're going to have the same justification that we need to apply to all of our fees to support that as a cost that we could collect back. So I think we'd need to be very cautious there.
We're not incurring any taxes on that because the county owns it. So we can only go after the taxes on the time we take it. So, and then if there's any additional fees that we've incurred on the property, like taking care of it, yes, then we would take that into consideration before we make the payout. Because we just did that on one of the properties, that cost property. So we took into consideration what expenses we had and then paid it out. But we could only take what taxes we had at the time we took it. So we aren't incurring any taxes on it.
I would worry that the carrying cost would be a little bit too speculative to justify. Certainly something that I can look into, though, as we're going through this process, because if we can justify it as a cost, then we should.
Lost taxes. All right. Any other questions? So Kim has a directive that we can go forward. We are, with our understanding of the Hennepin case and using the 50% of assessed valuation as a starting point for the bidding. That's something that Deputy Administrator Holman worked closely with the work group on setting up. So we've got a process. Kurt.
Just one other question, I guess, then for the clerk. How many properties are we currently sitting on that we could potentially move to the excess properties bidding list?
So here, just 1 second. $12 parcels.
But those parcels were continually still being listed where.
Those were the ones that we had listed before, and then when we revamped our process, we took them down.
Oh, okay.
And those are ones that we can send to Wisconsin Surplus to get started on. I don't have anything else.
All right. Are there any other questions? If not, thank you all for that update, and I think it's helpful for us to understand how those policies impact our processes, and we will continue to track those fees and charges and costs and going forward. Thank you. Anything else? If not, we'll move to 6B1, an addendum dealing with the allocating $50,000 in Marathon County opioids litigation settlement funds for purposes of conducting a gap analysis of continuum of care for treatment and recovery in Marathon County. And I asked that that be put on because we were basically spending county money. And it had gone through the Criminal Justice Coordinating Council as well as the Public Safety Committee. Who'd like to?
I can add one other thing. I think you summarized it very well. There was another committee it went through as well. It was a joint meeting of Public Safety and Health and Human Services. Again, the opioid funds are those litigation settlement funds. There are constraints on how the county can use them. The board requested the Criminal Justice Coordinating Council to take a look at that and conduct an assessment, which they did over several months to kind of evaluate what they thought was the best initial use of some of those funds. And the consensus of that group and ultimate recommendation is to use those $50,000 for that gap analysis. There is a PowerPoint presentation that was in the packets for each of those two subcommittees, as well as the Criminal Justice Coordinating Council. It's available on the website that talks through the other recommendations. But the first recommendation is that $50,000 for the gap analysis.
Are there any questions? If not, are there any motions? Chair Gibbs.
Make a motion that we support and move to the full board for consideration a allocation up to $50,000 of the Marathon County's opioid litigation settlement funds for the purpose of doing and conducting a gap analysis of the continuum of care for treatment and recovery in Marathon County.
Is there a second? Seconded by Supervisor Hart. Any discussion? If not, all those in favor will signify by saying aye.
Aye.
Opposed, no. That motion carries unanimously. Next, educational presentation, American Rescue Plan Act, ARPA update. We'll call on our finance director. Christie.
All right. Large spreadsheet. Because this large spreadsheet, we have a large amount of money. So, what we can do is take a look. What it shows is on the left-hand side is all of the projects that have been approved by the county board that would use ARPA. The dollar amount is the ARPA dollars. The project may be more than that, but that is the amount the resolution stated would be the ARPA dollars. Project identifier are the resolution numbers. The adopted budget originally, if you took every single resolution that the county board approved, you had approved over $35 million. That's too much. You don't have that much. So you did a reallocation on resolution 44-23 because some of the projects were done. And we determined that the highway projects that were going to be done on the 4-year plan would not benefit us in the way that it would not help us increase our ability to collect back the general transportation aids. Therefore, if you take a look at the third column in from the left, which is called amended budget, your overall total encumbered funds for ARPA are $25,026,417. You have been allocated $26,356,580. Therefore, the amount of ARPA that is left that has not been encumbered is $1,330,163. From that, we report on a quarterly basis the amount of money that we have spent with the federal government. And so we had spent on our legacy system through the end of 2022, $411,425. And it shows you the 4 projects that we had done. Then we got really busy and started spending a lot of those projects. As you can see, most of the resolutions were either approved at the end of 2022 or in 23. And therefore, in 2023 alone, we have spent $8.2 million. Therefore, the total project cost that we have spent through the end of last year is $8,611,648.94, leaving us a remaining budget of those encumbered funds of a little over $16.4 million. So the takeaway is you've encumbered or put in a budget a little over $25 million. That leaves you a little over $1.3 million left that you could designate to be used in some manner in ARPA. And of that, you've spent $8.6 million. And of those funds that you've budgeted, you have a little over $16.4 million left.
Christie, are we tracking the progress of the encumbered funds? And do we reconcile, let's just take the courtroom and the jail project. And if that comes in under budget, at what time do we free up those dollars or put them back?
That's a good question. Right now, as you can see, we've got tons of activity going on, and I'll go back to the other one. We we have tons of activity going on in 2023, and the departments have been instructed that we are going to try to close out any 23 by the end of this month. Latest is some of them have grants that have to be reported by February 20, the end of February. So the ARPA report will be out actually a week from tomorrow. And so we will then, after that time, be able to determine if some of those projects are done or if they are going to continue to be used in 24, and then we can get those closed out and probably do another reallocation resolution for you. I'm anticipating March, and then maybe on a quarterly basis.
So is there a point in time where we would want to identify as an expenditure lost revenue for the purposes of capturing and encumbering those dollars going forward? I just raised that as sort of that catch-all, because then we could put it into fund balance or someplace else for future use without the thought of losing that by not encumbering it.
I don't believe that if you're going to take the 26.3 million, that you're going to encumber it with a undesignated project. But we can,
lost revenue
no,
You still can't do it.
No.
Okay,
You
all
can
right.
spend it. You gotta allocate it.
to a project.
That's a-
one of the nice things about our new software is that it's Workday. Yes, this is super tiny, but as Supervisor Robinson was talking about, as you can see, it determines the project, the transaction, and then also indicates the grant, which we didn't have in our past software, and then a spend category so that we're able to have a really nice and detailed documentation of our transactions, particularly since there was $8.2 million spent in 2023. So one of the reasons we like our new software is because it is able to help us provide very good documentation and also gives us the ability to search by project or by the grant.
Chair Gibbs.
Yeah, taking up one of the questions, I think that the concern that is being raised that you highlight a little bit is we've allocated up to another additional amount to be spent in 2024. But by December 31st of 2024, we have to have allocated all 26.35 million. And if there's something that's going to be allocated, that's going to be not utilized in a budgeted item, we need to be able to identify that, recover it, and reallocate it before December 31st, at least as the rules are written today. There's still a concerted effort to try to get that extended at the federal level, but suffice it to say, as the rules are written today, we have to allocate them by December 31st. So if we're going to do a check-in at some point, I think the check-in is mid-year or closer to third quarter, end of third quarter, to identify any unspent allocated funds that potentially are recoverable to be reallocated. Does that?
The question that I would ask of the committee is that, you know, we've sort of talked about reviewing this on a quarterly basis to see where we're at, because we don't identify a surplus and then spend it the same month. We usually take some time. So is that quarterly check-in on where we are the appropriate level of check-in? Or do you want to see it more often or less often?
I'll just let you know that, again, we're going to have 23 closed out by the departments at the end of February. So I would suggest that March would be a great time to do that starting one, because we'll already be working with them to see where they're at. Then you'll be hitting the budget season, so maybe another check-in in June, and then we could probably do them every other month. And you guys would be on a pretty good track to figure out where your needs are and what you would want to reallocate.
What are your thoughts relative to that timeline?
I think that timeline works. I think the concern is that we've allocated a lot of the 2024 work into a lot of capital projects, and those capital projects sometimes take time to be able to develop what the costs are and identify all of those costs. The concern is, I think rightfully noted, that we have to be cautious to make sure that we're allocating appropriately, and that we're going to be able to utilize all of those funds.
Yep.
Other thoughts?
And the amounts needed to be budgeted by 2024, what we call encumbered, but they have the ability to be spent by 26, and that's exactly where you're coming. We need to kind of keep an eye on that, and particularly with those 11.7, almost 11.8 million in CIP funds. So, yep.
Are you
Yeah, I don't think it's a problem with those projects, and this pains me to say it this way, but if those projects have an overrun, that's fine, but in utilizing ARPA, but, well, I don't want to say an overrun, period, but, so, yeah.
I'm seeing the look of consensus. Everybody's nodding. So we'll rely on Christie to bring it in on a timely basis beginning in March, and we'll continue to get updates. But it is a critical function from a policy perspective because we don't want to unintentionally forfeit our funds. Thank you for that update. All right, the next item is closed session. I would looking for a motion consistent with the language on the agenda. Would somebody like to make that motion? Chair Gibbs.
Make a motion to go into closed session, roll call vote required pursuant to Section 19.85, Parent 1, Parent F, for the purposes of considering financial, medical, social, or personal histories or disciplinary data of specific persons, preliminary considerations of specific personnel problems, or the investigation of changes against, or charges against specific persons, which, if discussed in public, would likely to have a substantial adverse effect upon the reputation of any person referred to in such histories or data, or involved in such problems or investigations, to wit, discussion regarding the Register of Deeds.
Is there a second? Seconded by Supervisor Limmer. Any discussion? If not, clerk will call the roll.
Robinson, Leahy,
Aye.
Gibbs, Marshall, Hart, Lemmer, and Zhang is excused.
All right, with that, we will go into closed session. We would ask that the Corporation Counsel, clerk, deputy administrator, and HR director stay. Others, we will need to lock you out. Sorry, Allison and Supervisor Mosk. We can bring you in at a later point, but